Hey everyone, and welcome. Let's jump right into a complete data-driven explainer on the Caliber Mining and Logistics IPO. If you're a retail investor trying to navigate the primary market right now, you absolutely need to pay attention to this one. We're going to take a very close, objective look at what's really going on here. Right out of the gate, the market interest on this is just wild. We're talking over 25 times oversubscription by day 2. Plus, there is a massive 9,550 crore rupee order book sitting in the background. So yeah, this 450 crore public issue is turning a lot of heads for both institutional and retail investors. But as we all know, popularity doesn't always equal a perfect investment, right? So, to help you make an informed decision without all the hype, here is our agenda. We'll cover their business operations, the IPO mechanics, and their financial health. Then we'll dive into the bull case, the major risks, current market sentiment, and wrap it all up with a final verdict. Okay, Section 1, Business Operations Digging Deeper. So what exactly does Caliber Mining do to make money? Well, the name is actually a little bit misleading. Even though it says mining, Caliber doesn't own any mines themselves. Instead, they operate as highly specialized contractors. Think of them as the outsourced heavy muscle for the mining sector. Mine owners basically hire them to do all the asset-intensive, literal heavy lifting, excavating the soil, stripping away the rock layers, and actually extracting the minerals from the ground. When you break it down, about 86% of their revenue comes straight from those core coal mining services. Removing the overburden and extracting the coal. And this is mostly done for government-owned entities. The other 12% comes from their logistics and transportation side, which means physically moving that coal on the roads and coordinating the loading onto rail cars. Moving on to Section 2, IPO mechanics, the hard details. Let's lay out the exact timeline and mechanics for this offering. It's a 450 crore rupee issue size, and the price band is set between 402 and 424 rupees per share. Now, if you're a retail investor, you're looking at a minimum lot size of 35 shares. That translates to a 14,840 rupee minimum investment at the upper band. The subscription window is open from July 17th to July 21st, 2026, and we're looking at a tentative listing date of July 24th on the BSE and NSE. Now, where is all this money actually going? Well, 400 crore of the total is a fresh issue. And interestingly, the biggest chunk, that 208 crore, is going directly toward paying down their existing debt. Another 167 crore is earmarked for capital expenditure, so buying new machinery and commercial vehicles. It's pretty clear they want to deleverage their balance sheet while also gearing up for future growth. Next up, Section 3, Financial Health, Tracking the Numbers. So, are they actually making money? The short answer is yes, and they're doing it at a really impressive rate. We're looking at a massive revenue compound annual growth rate of nearly 33%. Their top line jumped from 953 crore in FY24 all the way to 1,678 crore by the end of FY26. And while they were doing that, their profit after tax grew consistently, with EBITDA margins holding rock solid at around 25.5%. And here is the kicker. This isn't just past performance. As of mid-May 2026, their order book sits at an incredible 9,550.89 crore. To put that into perspective for you, that gives them almost 6 years of revenue visibility based on their current numbers. They have a highly predictable pipeline of work. Section 4, the bull case. Why investors are optimistic. Why is everyone bidding this up so aggressively? Well, optimists love the fact that Caliber owns a massive fleet of over 1,900 vehicles. This creates a huge barrier to entry for competitors. Plus, doing all their own in-house maintenance keeps their operating costs super competitive. On top of that, Coal India has this huge mandate to outsource up to 70% of its mining work by FY30, which is a perfect macroeconomic tailwind for Caliber. And remember that debt repayment we mentioned? Wiping out 208 crore in debt will immediately lower their finance costs and give a really nice bump to bottom-line profitability. Section 5, Major Risks, the Bearish Perspective. As with any good explainer, we have to flip the coin. And honestly, the balance sheet tells a slightly different story. This is an incredibly capital-intensive business. Even though they brought in a record 411 crore in operating cash flow in FY26, their total borrowings ballooned to 1,631 crore by April 2026. Because they need a constant stream of brand new, expensive excavators and trucks just to fulfill that giant order book, they're forced to borrow heavily to keep growing. And bears are quick to point out some serious execution risks. Customer concentration is a big one. Over 85% of their revenue is tied to just two subsidiaries of Coal India. And listen to this, these contracts don't just automatically renew. Caliber has to continuously bid in public tenders and win as the lowest bidder, the L1 bidder. If someone underbids them, they lose the job. Add to that their extreme vulnerability to diesel fuel prices and the fact that they are heavily geographically concentrated in central India, and you could see why some investors are a bit cautious.
Section 6. Market Sentiment, Subscription, and GMP.
We've seen heavy oversubscription, and the early gray market premium is hinting at a potential 24% listing pop. But I want to pause here and be absolutely crystal clear. GMP is completely unofficial, it fluctuates wildly, and it is entirely unregulated. As a smart retail investor, you should never base your investment decisions solely on the gray market. Treat it as a loose sentiment indicator, absolutely not a guarantee of returns.
And finally, Section 7, Final Verdict, Weighing the Evidence.
So how should we look at this IPO? It really is a tale of two realities. If you're an investor who's comfortable with high debt, CapEx-heavy models, you might absolutely love their multi-year revenue visibility, that 33% growth rate, and their strong market share in a vital sector. On the flip side, if you prefer diverse, low-debt businesses, you might want to urge caution. The heavy reliance on Coal India and the constant need to borrow just to sustain growth are very real concerns. So, bringing it all home, it really boils down to one fundamental question for your portfolio. Do you believe their incredible operational efficiency and that massive 9,500 crore order book can reliably outpace the underlying risks of their highly leveraged balance sheet? It's definitely a fascinating dynamic to watch. Thanks for joining me on this explainer, and as always, keep learning.